Hello, 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 and welcome back to the Foreclosure Deals Coach podcast. On today's show, we're going to discuss how interest rates have affected the real estate market, dropped down a little bit, but now have popped back up. What gives? What's going on with interest rates and how it's going to affect real estate investing? Stay tuned. It's going to be a great show. Hello, 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 and welcome back to the Foreclosure Deals Coach podcast. I am your host, Donnie Corum, the Foreclosure Deals Coach, and this is the show where we help people just like you to find, figure, fund, fix, and flip a foreclosure deal with a minimum guaranteed profit of $25,000 from the coaching program. So a lot of this business depends on interest rates, and I can tell you that, when I really set out to be an operator, which is a term for a flipper who's doing a lot of volume. We decided we're going to do 50 flips in a year. We didn't quite hit that. 2020 was the year. We were rates were pretty low at the time, but we didn't know they were going to go even lower with the COVID crisis that was about to hit. But we decided we were going to go from, we were averaging 8 to 12 units a year to really pushing into that 50 bracket. It was a crazy time just to kind of decide to do this, and we put all of our effort towards it. Well, little did we know that COVID was going to really hit in first quarter of 2020. Rates dropped down to like 2%, 2.5%. It got really nuts. And of course, the market was propelled with rocket fuel to get to a much higher number. We were selling houses in hours, not even days. It was an absolutely incredible time. Okay. So it made the process of selling properties much faster because we were measuring the time on market so low. We just had to get them done. And in certain cases, we didn't even have to get them done. The market was so hot because of the low interest rates that they were selling in record amounts of time, often for above asking price, an incredible time. That went on through 2020, 21. Rates continued to stay really low. 22, rates were still really low for the first half. Then about June of 22, the government realized we were in an inflationary market. Housing prices were going up by 20, 30% a year, which was completely unsustainable, obviously, right? And then suddenly the government's like, we got to do something about this before, houses cost $1.5 million for an 800 square foot house. They do in certain areas now, right? And eggs and everything else go up with inflation to this crazy number as well. So they decided to raise interest rates drastically to curb the inflationary track we were on at the time. Well, that increase in interest rates obviously prevented buyers from being able to buy. Houses were now much more expensive than they were before, 30%, 40% higher than they were even the year before. So obviously a lot less people could afford those houses. And now the rates had gone from 2 to 3% up to 5, 6, even 7% at a time. Needless to say, this had a very negative impact on the foreclosure market. Why is it important to you as a real estate investor? Well, the goal of any investor is to anticipate the future of the market accurately in order to benefit from that future. If you're buying a stock, you're buying that stock anticipating that over time, the stock market overall is going to go up, and more specifically, the company you're buying that stock in is going to go up in value, allowing you to make more money on your money. That's just the nature of what we do here, right? However, when you can't really predict the market because there's a lot of signs or a lot of the information is conflicting, makes it very difficult to predict what the market's going to do. And that's where we find ourselves today. The Federal Reserve has reduced interest rates 3 times in a row now, which should have had an impact on mortgage interest rates. And to some degree it has. We're no longer pushing into the 7s. We've dipped down to the high 5s to mid 6s. And I want to show you a chart here to give you an idea on what's actually happening with the real estate market. Sometimes I bring up the Freddie Mac site. Here we go with Freddie Mac. You can see here that today, the U.S. weekly averages running about 6.44%. Right, which is still pretty high on the scale of things. The 15-year, we don't look at that as much because it tends to be a little bit lower. Normally, it can be a lot lower, but right now it's just a little bit lower. So it doesn't make a ton of sense to go with the 15-year mortgage because the gap is not that wide. But you can see here that rates, when they started to raise rates this year, we saw some trickling down effect. It wandered down. Here we are bottoming out at about 6% on the average here. And in certain cases, we saw it dip pretty, just below 6%, 5.875, even some VA rates seeing 5.5%. And now it started to trickle back up again a little bit. Well, if the Fed continues to reduce rates, that's hard to make sense why that is. Why are they increasing the mortgage rates even though the Federal Reserve rate, where they can borrow money from the Federal Reserve, is gone consistently lower? The answer is really tied to supply and demand, okay? Because rates went so high and prices went so high, the supply of money has come down. There's not as much money sitting around in the coffers to lend on mortgages because demand for mortgage rates has kind of come down. The mortgage guys who are left with money in the coffers are going, we got to make a little bit more yield on this money because it's been sitting around for quite some time. We got to get more money off of the money. My prediction is we're going to continue to see some decline, but even though things are lower, what we've not seen is a substantial decrease in the days on market. A lot of my clients right now are still facing the property sitting on the market awaiting somebody to buy the home. This is not saying that houses are not selling at all. It is saying that they're selling much slower than they have in the past, and they've not increased or decreased days on market as a result of the rates coming down. We're really kind of seeing some stagnation in the marketplace. So what gives? What's going on? If rates have come down and now are starting to pop back up, why are we seeing time on market stay high or even increasing in certain areas? Well, guys, I think what's left over is the election season. Here we are about 2 weeks from crowning our new president. And I know it's a democratic process and crowning is not accurate, but doesn't it kind of feel like we're trying to elect the new king and or queen of the market right now? It's a crazy time. This has been the most unpredictable election in a lot of people's opinion in very many years. Okay, we just haven't seen this much diversion, I guess, from the election season as we're seeing right now. What gives? Why is there all this stagnation in the market? Well, in my opinion, the reason we're seeing this stagnation is because we don't really know who's driving the country right now. Okay, we've got a war going on or breaking out in Israel right now. I don't think we should respond, but let's face it, we as a country almost always do respond to major conflict in other parts of the world, but we're not doing much with that, maybe to our benefit, but mostly because I just don't think they know what to do, right? The guy who's currently in charge for the last 2 weeks is kind of cleaning out his office right now, right? And I don't mean to get this political. I think all presidents do a pretty average job. I know there's a lot of people who are pretty anti-Biden, et cetera. That's not what this is about. I just think that now that they're closing up shop, knowing the current incumbent president's not even running for office, he's not really focused on what the country needs right now. And as a result, the market's got a lot of lack of clarity. Furthermore, we have a major hurricane system going on, just an all-out FEMA disaster in the southeast part of the country right now, and FEMA hasn't even reported to certain areas. A lot of that is controlled by presidential leadership, and currently, because there is no presidential leadership, more people are suffering. The net effect of that is the real estate market, as well as the stock market, as well as the market at large that we're so dependent on in the financial services arena, just does not know which way to go. And I don't think we're going to get any clarity in that until the new president is in place. Now, I've got my preferences. You've got your preferences. I'm a businessman, so I tend to lean towards the business side of this. But no matter who gets in, my belief is that things are going to start to improve once a new president is in place. But start to improve is the key element. I don't want to create the mindset that the moment the new president is elected, that suddenly things are going to switch the other direction. First of all, there's a couple of months, right, where we transition in the new presidency, so they're not even officially in charge until January 1st, right? The other issue that we have is they're not going to be able to just move things right away. I think what we're lacking, and the reason that rates have stagnated and the market has stagnated, is there's just a general fear of doing anything in a marketplace with lack of leadership. Okay, so until we get leadership, that stagnation is probably likely to continue. I would love to hear your opinion. We got a couple of viewers right now. What do you think? Why is the market still kind of stagnant? Comment wherever you happen to be watching this. We're on YouTube, we're on Facebook, we're on LinkedIn, wherever you're watching this live right now. I'd love to hear from you. Let's talk about it. Even after this live broadcast is over, please let me know your opinion on why you think the market is stagnating. Now that we know, we got an idea on why things are sitting still, the next question we have to answer is, why does it impact real estate investors overall? Well, we have to be able to know what the trends are going to be. When you're buying a property, you are predicting three numbers, and there's really only three numbers that matter. I call it my keep it simple, stupid FTC 3-number system. And the idea behind it is allowing anybody to do basic deal analysis. Those three numbers are as follows. You have to know, obviously, what you're paying for the property. What is your acquisition price? Okay, that's usually pretty clear. The seller's got a number that they want. The wholesaler, for buying it from the wholesaler, is going to tell you what they want from it for it. We bought a HUD repo, we just closed on it yesterday. We knew what the asking price was going to be, right? That doesn't mean you want to pay the asking price. The idea is you're negotiating with the seller, preferably a motivated seller, a bank when it's a foreclosure, or a private seller who just wants out because they're heading to foreclosure in a lot of cases, right? You're negotiating with that seller to negotiate your acquisition price as low as you can go while providing a fair offer that they can pay for the property, okay? So that's number one, your acquisition price. It's a critical part of the entire negotiation process, is getting that acquisition perfected. The second thing you're going to need is the rehab budget. Now, this number is a little bit harder to hit for two reasons. Number one, there's been a drastic change in the labor and material costs. Drywall has gone up 20, 30% in the last couple of years. Let's face it, everything has gone up 20, 30%. Inflation was alive and well when we were dealing with the interest rates being really low. The net effect of the interest rates being low is you're going to see an increase in the price of everything. Milk costs more, eggs cost more, everything in our lives has gotten more expensive. Well, that has definitely applied to building materials. So trying to determine your rehab budget, which is the objective, trying to figure out what is the cost of this rehab going to be, has gotten harder because the prices have gone up from where they were in the past. How do we solve that? Well, there are tools out there. One of the ones that we use is costestimator.com, where it allows you to see the two variables that are important to your rehab, which are your labor estimate and your parts estimate, right? And these databases are now connected directly with Home Depot. So they're going into the Home Depot pricing system and finding out that drywall is now $15 a sheet. I'm just making that up. I don't know the exact price, but it also tells us what the regional averages are for labor. So if a carpenter in Colorado Springs is $40 an hour, you'll be able to see that. That's just, and they're going out and they're surveying general contractors. I'm a GC. They haven't surveyed me yet because I'm pretty new, but these services go out and survey general contractors to find out what they are paying for labor in this current market. These two numbers allow us to define the rehab budget, because if we know we got to put up 400 square foot of drywall, we got to install this much in carpeting, we got to install this much in cabinets, we're building our scope of work, we can now accurately determine what we're going to pay for the materials in that scope of work and the parts and the labor in that scope of work, giving us a more accurate estimate on what we're going to pay for the total remodel budget. Okay, that's one of the hardest numbers to get. So you really got to be focused on that by getting a construction estimator, which I do for my clients. You don't have to do those numbers. We actually build that in when we're providing the property to the client. We've determined number two. Okay, so what are our numbers again? Number one, the acquisition price. Number two, the rehab budget, and number three, the sales price or after repaired value. We get that number by looking at the market and projecting based on what things are selling for right now, this price per square foot. Then we factor in condition. We look at properties that are in current remodel condition, meaning the owners live in the property. It's just kind of standard issue retail, right? And then we look at remodeled properties and we try to find a number that's below the remodeled property, because we're not necessarily going to go to the highest part of the market because we want to be conservative, but higher than the pure retail number by just a little bit to determine what we believe we can get for the property. Well, as they're playing with interest rates, okay, it's very difficult to determine that, because if rates go higher, if they're at one point now and they continue to increase, that's going to affect the buying power of the consumer. And that means we might have to sell that property for a little less. So it has gotten very difficult to predict ARV. We're still relatively accurate. What we don't know is when we're going to get that ARV. How long is the property going to be on the market? Because as interest rates climb, it increases the days on market, which is where we are now, why inventory is the highest it's been in about 15 years in most markets right now, because the desire was to slow the market down. And let me tell you, mission accomplished. The market's slower than it's been in comfortably 10 years. So now let's bring that back into why interest rates haven't come down and how it affects investors like you buying a deal. With the new president coming into office, the belief system is that there's going to be more confidence, because right now it isn't rates, it really comes down to consumer confidence. People don't want to make a buying decision at this level until they know who's going to be in charge, because it might impact their employment. It might impact where they live, right? There might be things that happen. Does the president really matter to the day-to-day life of the American? Not really, but the market most certainly does. Right? Because if the market is impacted, employers are going to lay people off if interest rates go too high because they're not producing as much. Right? We're already seeing that in restaurants and bars and things that have been open for decades. 50, 60 years they've been in business, going out of business in the last couple of years because of what's happened with the interest rates and what's happening in the market overall. There's just a general lull in the economy. Our belief is, and in anticipation, is that a new president, regardless of who it is going to spurn the market back into some semblance of reality. They're going to continue to drop interest rates. And at some point, the demand for mortgages is going to catch up, allowing the supply of money to go up and ultimately rates to come down, conducive with what the Federal Reserve rate is. But none of that has happened just yet. Okay, so your objective as an investor, believe it or not, this is one of the best times it's been to buy in quite some time. Why is that? Because everything's on sale. The saying I heard from Warren Buffett that I've stuck with me for years is be fearful when others are greedy and be greedy when others are fearful. Well, the market is in a huge state of fear right now. So it's my opinion that investors have the opportunity, and we're seeing it. We have so many deals available to potential investors right now. The real issue is there's so much fear in the market that a lot of investors just don't want to pull the trigger right now. Until when? Until somebody else is in office, right? I just signed a client yesterday, the Haywoods. Congratulations, guys. Welcome to the program. And, it's a smart move for them to get signed up because they realize that they buy a deal right now that by the time January wraps around, new president's in place, more demand for mortgages comes into place because more people are willing to come back to market under positive leadership. There's a good chance that the rates will continue to decline and the demand for houses will go up, which will actually increase the potential ARV of properties in the next 3, 6 to 9 months. Okay, so now is an excellent time to buy. Now, of course, I'm always saying it's an excellent time to buy. So was I wrong in the past? No, but the crystal ball is never working at 100%. This is a speculative investment. All investing involves risk. Real estate is no exception to that. What we try to do is mitigate that risk as much as possible by reading the tea leaves that is the market and trying to determine what the next best route is. What we are seeing now is that rates are creeping up a little bit, and that's very recent. Okay, so we don't want to overreact to that data, but that increase in interest rates means things are going to be a little bit slower, which means now is a good time to buy. Okay, we expect that rates are going to come down because the Fed Reserve has admitted that they went a little far on these rate increases. The economy has suffered as a result. So the prediction is the next few Fed rate meetings will result in an interest rate decrease. But until that factors over into the mortgage market, it's not going to make much of a difference to us as investors. So if the Federal Reserve rate is a lagging indicator of what mortgage rates should do. Does that make sense? So if we believe that the Federal Reserve is going to reduce rates and we believe that the housing market's going to start to increase, when is the right time to buy? Well, before that happens, right? If you believe a stock is going to go up, then you want to buy the stock before it goes up, right? That's the whole idea. The same applies to housing. If you believe that the market's going to go up, as I do and a lot of experts do over time, then the best time to get into the market is actually right now. Okay, so if you're thinking about that, you're like, I don't know, Donnie, it's fearful. I have a lot of doubt. Hey, listen, you're not alone. A lot of people are afraid of what the market is doing right now. A lot of people simply aren't going to move until the election season is over and maybe their favorite candidate gets in. Other people are not going to do anything if the blue states win, right? If this turns out to be a blue country again. Some people are going to be a lot more emboldened if the Republican Party wins this race. They're going to do more. They're going to make more moves. It doesn't matter which side of the equation you're on. It's determining what the best financial move is for you. And as your foreclosure deals coach, my advice is getting in the market, buying a property on sale, and starting to build your system. See, this is not about you doing one deal and making a bunch of money. I mean, don't get me wrong. That's super cool, okay? But what this is really about is building a system that no matter what the market is doing, you can adapt accordingly. If the market is trending downwards, you know you got to look to buy properties a little bit cheaper, right? To make sure when you're selling them, they might go for a little bit less, right? When the market is going higher, you can look at the market as a whole and go, I can pay a little bit more for this property. I might need to spend a little bit less on fixing it because that's where the big variable is, so I can get in line with an increasing market. When the market was increasing in 2020 and 2021, all we had to do, guys, was yell house for sale and it would sell. Condition didn't matter. Location didn't matter. All that matters was the 2.5% interest rate that the buyer was getting. Okay, I don't think we're going to get to that market in my lifetime ever again. But if we believe the market is trending that way, then you want to buy a house you can pay a little bit more for the house, spend a little bit less on the remodel, and still get the same yield because the profit is going to be on the back end when you sell it. If the market is trending downwards, you got to spend a little bit less on the property. You might have to improve it a little bit more, okay, to compete with the fact that the higher interest rates mean that buyers are only going to buy the nicest houses on the block because they're paying a higher interest rate. But that tells you can improve the property just a little bit more to encompass in that. And either way, it's a sliding scale. Okay, how do you navigate a sliding scale market? You get yourself a professional advisor, an advisor that's done 400 flips in this very market and can help you to do flips anywhere in the country, but has a specific focus right here in the Colorado Springs and Pueblo market, because I've been watching these trends and watching the market go up and down for the last 20 years. And not that I know exactly where it's going next, just that I'm far more qualified than your average Joe to tell you which way the market is going. Yes, you're paying for that advice, but like a trusted financial advisor, you'd be happy to pay advice to a guy who is making you 100% annualized in the market, right? You would look forward to paying that guy's bill because he's making you a lot of money. That's the advisor I want to be for you. And that's what I can do through the foreclosure profit system that I offer common investors just like yourself to find, figure, fund, fix, and flip a foreclosure deal. I want to wrap up with this. In just about 30 minutes, I'm going to be doing an executive roundtable where we're going to be discussing the system in great detail, how the whole thing works and how you can get involved in it. I'm going to post the link here to the page so you guys can join us. It's going to be at 11 o'clock today. So please join me. It's going to be very much about discussing this whole program, how I help you to find, figure, fund, fix, and flip a deal. I try not to be very salesy on this call because I know you guys are here to get informed, not sold. But the next one's going to really be detailing the whole program about how we find deals and how we go through the entire process and how the system works. Once a month, we'll be doing this executive roundtable thing with a lot of new friends I've recently made on LinkedIn. There should be quite a few people attending this. I would love to have you as well. If you got time to join us, should be about an hour where we go through the entire system and program and give you all the benefits of it to see if it's the right fit for your investing journey to help you get started doing foreclosure deals consistently, no matter what the market is doing. So I certainly hope you'll join me. I posted a link to my Zoom where that will be taking place at 11 o'clock today. So please join 11 o'clock Mountain. So that's about 36 minutes from right now. Okay. If you can join me, please come out. I'd love to have you. We'll go over the program. You can ask questions about the program. You can always do that here as well. But in the interest of keeping this more informative and that being more about the sales pitch, if you will, trying to separate that out. So please join me at the executive roundtable here in 36 minutes at the Zoom link I posted there in the chat. So with that, guys, that is our show for today. What gives? Well, nothing's going to give to the election. All right. So let's just hold on tight for a little bit. But if you want to get started in your investing journey, we can get you set up, get your LLC structured, get you qualified for a loan to buy the property, get your funding in place, start lining up your general contractors and all those other pieces. So when everything is moving at the right pace, you too will be able to make a bunch of money flipping in any market because you'll have the right system in place. And should that market of 2020 ever come upon us again, I literally cleared almost $1 million in 2020. Okay. And the way we did is just the right time of having the right systems in place coupled with the right market situation. It's a combination of luck and skill, guys. And I'm telling you, that's been the real estate market forever and the market in general. So now is the time to build the skill. The luck part comes in with timing it well. In the meantime, you can make an incredible living doing 3 to 4 flips a year at an average profit of $25,000, which is exactly what my current system teaches you how to do. You can get involved. I can help you to do it. I would love to have you as part of the foreclosure profit system. With that, this is Donnie Corum, your foreclosure deals coach, thanking you yet again for tuning in and reminding you now and always, don't buy a house, buy a deal.